We're going to look at investments in terms of treasury bills, money markets, and how the calculations are done. So the treasury bills, we talked about short-term government securities, whose maturities are within a year. These ones are issued at a discount, yet redeemed at a face value. So the differences are the purchase prices between the face value and the repurchase price. So characteristics of treasury bills is that they vary in maturities from 91 days, 182 days, 364 days. And these are risk-free because they are backed by what? By government. And they have no periodic interest. Income is just through price appreciation. So they are highly liquid. So when you're dealing with treasury bills, the formula that we use to calculate treasury bills is as given below. It's given by the face value times 1. That is the formula for the treasury bills. Price is equal to the face value 1 minus R times T over 360. So where R is the annual yield, then T is the time in days, then treasury bill discount yield is given by the face value minus price over face value times 365 over time times 100. Okay, so this is how we calculate the treasury bills. Then the market yield is given by the following formula. Market yield is given by the following formula. Money market yield, MMY, is discount over price times 365 divided by time times 100. So this one is based on the purchase price. It has no face value. It has no face value. All right. So the characteristics of the money markets, we've already discussed them, and also how they're used. Then we go to now discussing the commercial paper. What is a commercial paper? This is another instrument that we use in the money market. Commercial paper is another important instrument that we use in the money markets. It has the following features. Number one, the commercial paper has maturities that are less than 270 days. It is issued at a discount, but they are not backed by collateral. The commercial papers have a higher yield than the treasury bills, but they have more risk. Okay, so the return is high, but the risk is also higher. So these commercial papers are short-term promissory notes. The people that issue these ones are usually corporations that have good credit ratings. Okay, they are used mainly to pay the short-term liabilities like the payrolls, the inventories, the other operating expenses. So they're issued at a discount and they're redeemed at face value. So maturity ranges between 1 to 270 days. Beyond that, regulations with securities may be required if it exceeds that. They are not secured, meaning they're not even backed by any collateral. Okay, they make them riskier than treasury bills. They have discount issuance like treasury bills. The CPs, commercial papers, are sold at a discount and matures at par. They offer higher yields, so they offer higher returns than treasury bills to compensate the credit risk. Generally, they are issued in higher denominations. They make them more attractive. The relevance they have is that they are used as a cost-effective alternative to short-term bank loans. And they play a very critical role in the money market because they provide liquidity to corporations. right? So commercial papers are very essential when we're making investor decisions because they offer a balance between risk and return. Then we have another document that is called a banker's acceptance. A banker's acceptance, a BA. It's also a short-term debt instrument, primarily used in international trade. It represents a time draft that is accepted and guaranteed by a commercial bank. It makes it more trustworthy for parties and familiar to each other. So here, the process or mechanics that are involved here, there should be a trade agreement. So an importer and the exporter will agree to settle using a time draft. Then a draft is then created. So the exporter will draw what is called a bill of exchange or time draft on the importer. Then comes the bank acceptance, where the importer will present the draft to the bank. So the bank will accept the draft and will agree at a specified future date to pay. And the first step is you return to the exporter. So the accepted draft is then returned to the exporter. Now they'll carry the bank's guarantee. Then they'll offer a discounting option where the exporter may sell this bank acceptance at a discount in the money market to receive immediate cash. Then in secondary market, the bank acceptance is is actively traded in the secondary market where it will offer liquidity to others. And on maturity, the bank will pay the holder at face value. Now, what are the features of this bank acceptance? It's secured by the bank. So the bank's involvement will add some creditworthiness and security. So it is usually used in trade finance for financing international transactions. It is a discounted instrument like the treasury bills and the commercial paper, but it is sold below par, but redeemed at par. So it's a tradable asset, which is used in the secondary market as collateral for loans. So it has a lot of benefits to investors and businesses. So for exporters, bank acceptances will offer payment, assurance, and liquidity. For banks, they provide short-term assets and generate fees. For investors, they offer low risk returns. So these are some of the advantages. So they improve liquidity, they reduce on default risk, they're generally accepted. Now, let's quickly look at some of exam papers regarding that. We already did question number 1 in the previous lecture. Let's look at question number 2. Treasury bill has what? 10 million kwacha face value issued for 90 days and will be redeemed on maturity at 10 million kwacha if the 3 months yield at the same time of issue is 5.25. Determine the price of the bill, 5 marks. All right, so we had alluded to the formula. So we're given formula. What is the formula for a treasury bill? So the following was the formula for the treasury bill. The treasury bill is given by face value minus price over face value 365 divided by time times 100. So in this regard, what are we given in our question? So identify the parameters that have been given there. Been given the face value. There's the face value, 10 million. What is the discount rate? R, 5 point what? 25 per annum. what is our term in terms of the number of days? Our T is 90 days. So we need to fuse in this formula. All right, so based on what we're given, we need to now fuse in the formula. So we have our face value, which is 10 million. Then we have our discount rate, which is 5.25%, which will come here. The R 0.025. And we're given our time, 90 days, which will come here. And 365, the number of days we have in a year. Then the first value was 10 million. So when you calculate this, 1 minus that, it will give you approximately 9.8 million. So this is how we calculate the treasury bill. Remember, by definition, we say the treasury bill is what? Redeemed at a discount. Okay, we say the treasury bill is redeemed at what? At a discount. So it's a short-term debt instrument which the government uses, matured within a year, is redeemed at a discount. And the difference between the purchase price and the face value is what the investor will make. All right. So we go to our next question. That is 5 marks. Our next question is, the newly issued 3-month treasury bill with par value 10,000 was sold for 9,700. Compute the treasury bill discount. So if we master the formula, so the treasury bill discount is the par value, the par price, par minus the price over par times 365 over 90 times 100. So in this case, our par value is 10,000 and our selling price is 9,700, as you can see. So we'll substitute that in that formula for our treasury bill discount. It is given as a percentage. So our par value is 10,000, selling price is 9,700. So the 10,000 is the par value which will come here. The selling price is 9,700. The par value comes here, and it's 100, so you get 12.17%. So this is what we call the treasury bill discount. Okay. What did we define the treasury bill discount as? The treasury bill discount is the difference between the face value or the par value of the treasury bill and its repurchase price. So treasury bills are usually issued at a discount and then they're redeemed at the full value upon maturity. So the discount represents the investor's earning, how much the investor is going to earn. So it is given by the face value and as the purchase price. Okay. So in terms of the formula, it is given as such: face value minus the price over face value times 365 over T times 100. T is the number of days to maturity. Are we following any questions so far?
Yes, we are following, just trying to grasp the formula.
Okay. Yeah, you get there. The formulas are usually given. So yeah, just an issue of what? Substituting. So when you substitute, just need to remember the formulas. You're going to get 12.17. You substitute the figures there. Okay.
Mm. Like Collins.
Yes.
Yes, I was kindly asking if you could just take me through again the calculations.
For part B.
Yes, yes, yes.
All right. So we are told that a newly issued 3-month treasury bill, newly issued 3-month treasury bill. 3 months is what? 30 by 390 days. So already from here, you're able to get a newly issued 3-month treasury bill. So we already have our time here as what? 30 days times 3, which is 90 days, with a par value of what? 10,000. So this is our face value. And was sold for a price of what? 9,700. So our price is 1,000. So calculate the treasury bill discount. So treasury bill discount, what did you say? Discount is given by what? Face value minus price over face value times 360, 5 over time times 100. You are given the formulas. Okay, so let's check down there. Given the formula, so you need to do. So you now substitute that. So what was our face value? Our face value was 10,000. Our purchase price, 97 over face value 10,000, 360 over the 3 months, 90 times 100. So just an issue of computing that to give you 12.17%. So this is our discount rate. Right. So we go to our next question. A 60-day commercial paper has a nominal value of 10,000 kwacha and is issued at a discount of 7.5% per annum. Calculate the money market yield at the time of the issue. Calculate the money market yield at the time of the issue. Remember, I gave this formula for the money market yield. What is the money market yield? And what does it entail? The MMY.
I didn't see the formula.
So you just forgotten.
Maybe.
So I said the money market yield, which is also known as the investment rate yield, is one way to express an annual return for short-term securities like a treasury bill or a commercial paper. It is usually based on the price that is actually paid, which is a purchase price, not the face value. So it is this yield that will help investors understand why they earn certain percentages. It is called the money market yield. Okay, so money market yield is given by a formula. But before I go to the formula, let me repeat what I just said. What is the money market yield? Money market yield is simply a way to express the annualized return on a short-term discount security like a treasury bill or commercial paper. It is actually based on the price that is actually prepaid and not the face value. It will help the investors understand why they earn a percentage relative to the amount they invested. Why is the money market yield used instead of the discount yield? The money market yield will what? It will show the return as a percentage of the purchase price, which reflects the actual amount the money an investor will put at risk. Whereas the discount yield will base the returns on the face value. This one will base the returns on the purchase price. Okay, so we have a formula for the money market yield. What is the formula for the money market yield? The money market yield is given by discount over price times 365 over time times 100. So based on this formula, we can calculate and go to our question now here. We have a 60-day commercial paper. Okay, it has a nominal price of 100,000 kwacha. It is issued at a discount of 7.5% per annum. It has to calculate the money market yield, 5 marks. So in that question, what are we given? Given in that question, we're given the nominal value.
So we are given the, yes.
What else? What's the nominal value?
We are also given, it's 100,000
Yeah.
kwacha.
Mm-hmm.
Then we are also given the time,
Mm-hmm.
60 days.
Mm-hmm.
We are also given the discount at 7.5% per annum.
Yes. Okay. So we need to calculate our money market yield. Now, the money market yield, how many marks is that?
It's five max.
Money market yield. So what is the formula for the money market yield again? Say the formula was what?
So it's going to be discount
Mm-hmm.
over price
Mm-hmm.
times 365
Mm-hmm.
over T time
Mm-hmm.
times 100. Yes, that one there.
Okay. So what are we given again?
So we can substitute. We are given the discount there.
What was the discount?
Um, that's seven. It was 7.5. So, where's
What was the
my
discount?
calculator? Just a moment. So it's going to, yeah, so it's going to be 0.075 on the discount.
Mm-hmm.
Then what else? Over the price, which is 100,000 kwacha.
Price is 100,000 kwacha.
Then, yes, then we do times 365 over 60,
Okay. Now,
right?
yes, you are partially right. The 60 is correct, but we need to calculate the discount and we need to calculate
Ah,
the price as well. Okay, so
oh, okay.
these ones have a calculation to be done. So
Oh, yeah. Okay.
I don't know why these marks were given, they were very low. Was the process. All right, so let's go firstly to identify how to calculate the price. So they're given the nominal value of 100,000, the discount rate 7.5%, and time to maturity 60 days. So to calculate the price, firstly, we know the price is what? Nominal value, 1 minus discount rate, time over what? Over 365. Is that clear?
Yes.
Yes.
Okay,
Mr.
so
Collins, you are muted. Okay.
you have a nominal value of face value 100, the discount rate 7.5, and time to maturity. So this is what you use to calculate firstly the purchase price. So the nominal value 100, 1 minus discount time over. So we it already talked about this price, how to calculate the price. Okay, so this one will give us a price of what? 98,000, right? So this 98,000 we have it now. Secondly, we now go to calculating the discount itself. What is the discount? The discount is the difference between the face value and the actual price. Okay, so the discount should be equal to the face value minus the actual price. So our face value is what? 100,000. So this is the gain that the investor will have. So second step is we need to calculate the profit, the discount we are getting. So 100,000 minus the answer we just from calculating 98,000, we get 1,200. So this is how much we're going to receive at maturity. Are we together so far?
Yes, sir.
Right. Then remember the formula for the money market yield. We now apply in our third step, the money market MMY. So it is discount over price, 360 over time, 100. So the discount itself that we just calculated, the 1,000, the actual price, which is the 98,000, 360 over 60 times 100. So when you calculate, we get 7.59%. Remember, this one is not based on the face value, unlike the other one. It's based on the actual price. So this is how we calculate the money market yield. Okay, are we together?
Yes, so far, so good.
Okay, then our last question for the morning, outline the steps for bankers' acceptance. So we talked about the steps for bankers' acceptances. Who remembers? What are the steps that are involved in bankers' acceptance?
Mm. So the buyer and the seller should both agree. They
Yeah,
should be agreeable.
agreement is number one.
Mhm.
So the buyer and seller should agree on the terms. And a draft drawing. So the seller will draw what is called a time draft. Then the buyer's bank will accept the draft, promising to pay on maturity. Then it is accepted, it is returned to the seller. And the seller may sell this acceptance at a discount for immediate cash. Then trading will take place. So the banker's acceptance will be treated as a security in the secondary market. Then the holder will present this to the bank on maturity for payment. So they'll use this as collateral. It can be used for financing or credit enhancement. So the bank's acceptance will increase the instrument's credibility. Then the settlement will be done upon maturity. So it's just a guarantee that the bank says, okay, this person wants to engage in trade. We know this person. Yeah, you guys don't know each other, but we're assuring that in the event that it doesn't still come through, we are here to pay, in short. All right. So based on these, I will ask you to do this question as your homework. Any questions?
No questions. It's clear. I think I just need to go through. Okay.
So
Are you going to share the recording or after we do the? Okay, I'm coming. I'm coming.
I'll share the recording.